My name is Nolan Wapenaar. I'm Co-Chief Investment Officer, and I'm going to start to get into the detail for different asset classes. I'm going to talk a little bit about the global macro environment, what that means for our asset allocation, and thereafter I'm going to delve into the fixed income asset classes. So if we look at the global environment, the best metaphor I've got is, at the moment, from a macro perspective, it feels like a tug of war. It's a tug of war that started last year with COVID effectively and the consequences of COVID effectively pulling to slow down the economy, and then governments and central banks reacting with fiscal stimulus. In other words, the checks that Henry was talking about, sent out to people, increased government spending, etc., and then monetary stimulus, which is basically interest rates cuts, and then bond buying programs, quantitative easing. So you've got this tug of war that's taking place, and in 2020, clearly COVID won, we had a significant global recession. Moving into 2021, this year, we think this will be the year of recovery. So we think that the effect of COVID will reduce. We think it's going to slow down. And similarly, actually, we expect the effect of monetary and fiscal stimulus to slow down, and that the tug of war will basically be less strong on each side. Unfortunately, though, if you think about it, they're not both going to slow down by exactly the same amounts over time. So at times, I think the pull from COVID might be stronger. At times, the fiscal and monetary stimulus pull might be stronger. And that means we're going to be in a volatile environment, because the market is going to react as we feel one side or then the other, seems to have the upper hand at any point in time. In terms of COVID, obviously vaccines is the reason that we expect the COVID pull to dissipate over the year. And Peter is talking after me. We'll talk a little bit more about that. In terms of fiscal stimulus and monetary stimulus, we have seen very significant stimulus. And we expect that President Biden will shortly announce the next stimulus package, which hopefully will put $900, it's 35,000 Rand in the back pockets of Americans. That lady that Henry had up a few minutes ago. Significant stimulus into the market. The thing is, that's probably peak stimulus. That's likely where it stops, and thereafter stimulus slows down. In terms of stimulus, you get stimulus, as I said, from the central banks, and you get stimulus from the government. We are talking, we've got here a chart showing the size of the balance sheet of the US Federal Reserve over time. And basically, you've got a time series, you've got the size of the balance sheets, and you can see how over time the balance sheet has grown. This effectively is a graph showing you the amount of stimulus that the Fed has pumped into the American markets, into effectively the global financial system. And what's interesting about this chart is, about a year ago, I stood with a graph that looked very much like this. And I was talking about how the US had been trying to reduce the amount of stimulus, trying to withdraw the stimulus. And you can see how that graph actually turns down from about May 2018 through October 2019. The thing is, that little withdrawal of stimulus, just that little amount in the context of the greater volumes, caused massive ruckuses within the global environment. We had banks in the US that suddenly were squeezed for cash. We had massive dislocations in the interbank funding market. We had LIBOR that went completely crazy. And that's the consequence of a very little withdrawal, just to put it in perspective. So what happened in 2021? Well, the Federal Reserve turned around and just absolutely sort of hit the market with a tidal wave of stimulus. We've seen that manifest in asset prices over time. We've learned from our previous experience, stimulus once given is very difficult to retract. So we don't think that the stimulus will necessarily be taken away, but we do think that further stimulus is unlikely beyond the near-term checks that we expect to be sent out. So from that perspective, we expect the benefits of stimulus to slowly dissipate, and it's a question of how it dissipates versus what we're seeing on the viral side. That's going to cause the uncertainty and the sort of volatility that I was talking about. Looking at economic forecasts, what we've got here going back to 1980 is, in the dark blue bars, the actual global economic growth year on year, and you can see how the economy is growing. You can see 2008 a small recession. That puts in context the extent of devastation globally in 2020, which is one of the most significant contractions on record. Interestingly, the light grey bars are forecasts, and you can see the economies are expected to rebound this year. The rebound is expected to be tail-ended. In other words, once the virus is under control because of vaccines. But the other point I'd make is that actually the rebound is slightly smaller than the rebound after the global financial crisis in 2020, and the rebound also is a little bit uncertain because of how this is going to play out. So it is still an uncertain world. That being said, the broad consensus is that we're going to start to see a massive bounce back from the lower positions we're in. Looking at South Africa, though, we've got to look at the South African macro environment. There's a tug of war going on within our own government and within our own country. And it's basically a tug of war between the government trying to manage itself so it does not run out of money versus the government trying to regain people's trust so that people start to invest in our economy, so that our economy starts to kick off again, starts to burn the way it should. So in that context, this is an old discussion that we've had for many times. There's nobody in South Africa who isn't aware of the difficult dynamics that our government is facing, and this is something we're concerned about. In the short term, the markets are going to be looking at wage settlements. And the government is looking to rein in its spending by basically freezing state employee salaries. We can debate about whether or not this is appropriate, but the long and the short of it is the government is doing this because it has no choice. There is nowhere else that is going to be able to cut expenses by a sufficient amount to actually get the finances under control. We noted that the government won its first court case late in December against the unions. I was actually surprised. I wasn't expecting it. As to be expected, the unions have taken that to the Constitutional Court. So we'll watch and see. Eskom, again, no surprise. We know the challenges of Eskom. I think, as Anton de Ruyter puts it, from Eskom's perspective, their balance sheet has 250 billion rand too much of debt, and somebody has to pay that debt. The taxpayer can pay it through increased taxes, or electricity consumers can pay it through increased tariffs. But there's no getting away from it. Somebody's got to pay for the mistakes in the past, and unfortunately, that is something that continues to haunt Eskom because there are no easy answers. Maybe on the more positive side, the liberalisation of the electricity market is taking place. Stefan will talk about that in a few more minutes, but we are seeing significant additional renewable power being added to the grid. And we are also seeing an ability for cities to start looking at procuring electricity from non-Eskom sources. Both of these should at least sort out in due course our blackout. And then finally, we are hopeful for the construction initiatives, the growth initiatives announced by President Ramaphosa. And I'm again going to allow Stefan to talk about this further. But it's really very important for South Africa to start to focus on initiatives that build infrastructure, build the right infrastructure, and finance it appropriately. So that's South Africa in a nutshell. But putting it all together, our asset allocation views are very much like they have been in the past. It's going to be a volatile world. It's going to have surprises. And in that sort of environment, firstly, a balanced portfolio makes sense. So we prefer slightly bonds and we prefer alternatives. In other words, we think hedge funds should begin to make a comeback. We think that structured notes will make a comeback. But that being said, domestic equity we're incrementally more positive on. I think the environment is improving. We can clearly see that come through. We've seen some good performance from domestic equity early in this year already, listed property similarly, and same thing for global equity. So the message to take away is we do advocate for balanced portfolios. We're slightly more positive on bonds and alternatives at this stage, but it's going to be a bit of a bumpy ride through 2021 still. Turning specifically to asset classes, and I'm going to start with our RAND view. Usually I do this at the end, but I think it's a good point to start with this time around. And to talk about the RAND. So what we've got here is a chart that we drew. This was drawn up on Wednesday, and it looks at the performance of the RAND, which is the red bar, versus the performance of other currencies against the US dollar. And over the short term, we've seen significant RAND strength. It strengthened in the last week by 1.85%. Over the last month, it's depreciated by 3%. Over the last 3 months, it's appreciated by 10%. So the takeaway from that is that in the short term, the rand is living up to its reputation as being an incredibly volatile currency. That is going to continue. That is probably actually going to increase over time, partly through it's a negative consequence of the zero interest rate policy that Henry was talking about. It's also a negative consequence of our political environment. What is potentially more interesting, though, is if we start to look at a longer period, and we can look at the currency for 1 year. I could actually look at this for 5 years as well. Over 1 year, the rand has depreciated by 3.26%. Actually, it hasn't depreciated by much. And if you took your money out of South Africa 1 year ago to the day, and you put it in a bank account in the US and waited for a year, you were actually worse off, which is quite a stark realization. And the takeaway from that is 2 points. The first is that if you are looking to invest abroad, and Anchor does advocate investing abroad, but don't do it because you expect rand depreciation to increase your financial asset performance. It hasn't done that for the last 5 years. Instead, invest abroad because you want to diversify your balance sheet, because there are better opportunities offshore, or to be honest, because we do have a distrust for our political environment, and it makes sense to be invested offshore. Secondly, so do it for the right reasons. The other point I'd make is that last year, because of the volatility of the rand, there are significant opportunities for active asset management. So, the clients of ours who worked with us and took their rand off at the beginning of the year, there were quite a few of them actually, when the rand hit 19 against the dollar, they brought all their money back into South Africa, and they've actually just taken the money out a second time around. Those clients who were actively managing their positions, who worked with anchors, advisors in that respect, have benefited significantly from the currency. And we ask you to consider that as well. In terms of the rand, we do apply a PPP, purchasing power parity model, which basically says that over long periods of time, the rand should depreciate against the US dollar by approximately the inflation rate differential. If you statistically go and model this over long periods across the world, you actually find it's pretty good, actually. But the point I want to make is that you saw last year how the rand spiked way out of our PPP range. It actually started the year in our range, went absolutely crazy at the time of COVID, and it's come screaming back such that it's actually within our range again. Our view on the rand looking forward is that it's going to be a bumpy ride. It's probably going to push out of the range at some point. However, it's very likely to come back into range. And from a year-on-year basis, we think the rand is probably fairly valued right now. And that means we've got in our models a negligible amount of rand strength, but essentially we don't think that the rand's going to move materially one way or the other over a longer period. Over the shorter period, as I said, it's a volatile currency. Anything's going to happen. So that feeds into our balanced view for financial assets. Turning into more fixed income assets, bonds, which is my primary discipline here at Anchor. This is a chart I actually showed 6 months ago. And what we are looking at here is the real interest rate available in different countries. So basically what we do is we look at the yield on the 10-year bonds. So South African 10-year bonds yield 9%. We go and we subtract the inflation rate. Let's pretend inflation's at 3%. 9 minus 3 is 6% over inflation that you can earn from a bond, and that's what this chart is showing for different countries. The point I'm making is that if you look at all of the established emerging markets, Indonesia, Malaysia, Brazil, etc., South Africa screens as paying the highest real interest rates in the world. And that is quite significant for us because it keeps our bonds attractive. There's a reason that foreigners have been buying South African bonds this year. Late December, foreign participation in bonds has been sort of trickling down over time. That started to increase, and the foreign holding of our bonds has started to increase. That is likely to keep our bond market well supported for a while. The bonds are actually quite attractive on that basis. It'll also actually keep the rand supported. Very interestingly, if you start moving into frontier markets, and South Africa's on the cusp of, regressing back into a frontier market or pushing into being a more established emerging market. But if you compare us to their frontier markets, they do offer higher interest rates. However, accessing their bond markets is a complete nightmare and it's very, very inefficient there. So South Africa is kind of the most attractive of the reasonably established markets. In that context, we do like South African bonds. They do add good value, but it's not without risk. And we understand the political risk, the economic risk in South Africa. When we model it through our econometric models, which is basically a multi-factor regression analysis, what we come out with is that South African bonds are fairly pricing in the risks right now. So they're not a sort of humbling opportunity, but they are certainly fair, and we do think that you will be rewarded for it. So to sum it up, we think South African bonds will be volatile, as with all asset classes. We think that the yield you're earning is fair and attractive. We think in most scenarios, actually, South African bonds are going to perform well, and we think that there will be an underpin from foreign participation. Moving to global bonds, it's a bit more difficult, but what I'm looking at here is a chart that shows each year the economist predictions of what the global bond interest rate would be. At the beginning of the year, Bloomberg would go and poll all the major economists in the world. What do you expect the 10-year bond yield to be? And if you look over that year, the bond yield sort of slides down, expectations slide down, and the bond yield ends a lot lower. We'll skip 2012 for a second, but 2013, 14, you can see how each year the expectations are quite high, and then as reality sets in, expectations of interest rates come down. What that means is that economists tend to overestimate the likely bond yields, and as a result of that, the expectations at the beginning of the year are quite high, and they tend to sort of come down because the world isn't as rosy as economists like to think. Economists for 2021 are projecting a global bond yield of 1.25%, which is quite low. In the context of economists always getting it wrong on the high side, we actually think a more reasonable target is about 1.15%, and that's a reasonable target. A lot of people are saying, well, what if interest rates really take off? What if inflation comes back? We can't explain why it will, but it might. If that does take place, bear in mind that global bond yields started 2021 at about 1.6%. So even before, or started 2020 at 1.6%, even before the crisis, bond yields weren't particularly high. And if they were to normalize to those levels, it still isn't a major catastrophe. In that context, as I said, we are projecting bond yields of about 1.15%, and actually that's pretty much where the market is right now. So pulling together global bonds, again, we think it's going to be volatile. Interest rates are very low. You are investing to earn interest, so you've got to accept that globally income isn't as available as it is in South Africa. Keep your duration short. In other words, keep your bond risk short. You don't want to take the risk that there is a surprise, and there is a significant opportunity though in short duration positions to pull some cash out of the equity markets if you're so inclined, and to put it on the side, and you should be able to eke out at least a half decent return. And in that context, we've actually recently launched the Anchor BCI Global Income Fund, which does exactly that for our clients, and it's targeting a return of about 2% in dollars for clients who are looking to just take their foot off the gas in the global equity environment. So ultimately, to sum up what I've been saying, where will the money be made? In South Africa, it's all about how much bond risk you want to take. So if you're in a money market fund, you are expecting to earn about 3.7% this year, but it's going to be very stable. Core income funds, which are ideal for corporates that might be sitting on a lot of cash, Anchor Core Income Fund should generate just under 5% return, far better than you're getting out of your bank. It's doing that with a negligible amount of additional risk. Flexible income funds is ideal for retail investors, not corporates, but other investors who want to invest, pull some money out, sit on a safer pile of money. You're taking a little bit of risk, but you're going to earn between 5.5% and 6% on that for the year. So that becomes an attractive proposition for many people who just want to de-risk at the moment. And finally, we've got the bond fund for investors who are looking to generate significant income. We're averaging just under 9% returns on that as an expectation, but you are taking quite significant risk up and down. Over the long run, bonds are mean reverting, which means it's all going to work out in the long run. You've just got to have the stomach and the comfort to sit and wait for the long run, which isn't always that easy. But income does offer an attractive investment proposition. Summing it all up, where will the money be made? Domestic fixed income, we should be able to generate between 6 and 10% per year. It means buying bonds, it means being patient. Global income, we're going to avoid duration, we're going to hold corporate bonds, and we're looking to earn between 2 and 3% yields for our investors.